So we have had a fantastic discussion so far on the conventional part of the debt market. We have had a fair bit of discussion on GSECs, HTLs, Muni bonds, and these are all really high quality debt instruments. So we're now going to transfer to another world of debt investments, which is very different from the kind of debt investments that we usually see or hear about. Some call it performing credit, some call it alternative debt, and to go deep into this segment of the debt capital markets, we have a very exciting lineup of speakers and panelists. So I would like to first call on stage Bala, as is fondly called. So he's a Chennai rock star, and he's the co-founder of Anicut Capital, which manages several credit AIFs, and he brings with himself more than 25 years of experience in corporate banking and the debt space. So he's a great person. Thanks so much, Bala, for taking out time. Welcome. Next, I would like to call Shekhar Daga, who's the head of private capital at ICICI Prudential AMC. So in his long career, Shekhar has handled the entire gamut of investment management, different functions: corporate lending, structured finance, private equity, special situations, distressed debt. So he's really seen it all, and it's really a pleasure to have him here. So welcome, Shekhar. Next, please welcome Mohammad Irfan, who's fund manager at Vivriti Asset Management. So Vivriti is one of the largest and fastest growing asset manager in the credit alternative investment fund space. And Irfan manages several of those strategies. And in many ways, the folks at Vivriti can be credited with playing a very important role in creating this asset class of credit AIFs. So it's really nice to have Irfan from Vivriti with us to talk about it. Welcome, Irfan. Lastly, I would like to call Munish Randev, who's founder and CEO of Servin Family Office. So we really could not have a better person than Munish to moderate this discussion. So I remember my days at IFMR when we were trying to reach out with our credit AIFs to the private wealth segment. We always invariably hit a wall. And Munish was that rare gem who actually understood and appreciated the nuance of having a robust debt strategy. So it's great to have Munish with us to moderate this discussion. So over to all of you. Looking forward to your discussion.
Thank you, Ravi. Thank you. We actually get into a fixed income conference because we are bombarded by venture capital conferences and equity conferences. And as I joke with a lot of people that half of most people's portfolios is fixed income, but we don't get to see that kind of focus coming in that space. So I think it's very heartening that this is happening at the right time as well. A lot of I'll call it a lot of upheaval in the market as well. A lot of activities happening in the fixed income market space. The topic today is something which has been there for a long time in India. It is just that it's not taken a lot of buzz as far as maybe media is concerned, but a lot of large investors are already allocating money in that space. And from the panel you would have seen we've got the best experts from that space right here on the dais today. The idea is very simple, that in the fixed income space everything is not similar. We saw the session on SDLs and Munis earlier, and these are very old types of instruments globally as well. In India they're just taking shape, but there are other forms of fixed income investing as well, which are maybe a bit more higher risk side comparatively speaking. So I think that's the space we will be speaking about. I will not take much of a time to just talk about the markets. I think let's the gentlemen talk about it. I think the idea is to just lay the context of what we are talking about and just ask about what do you actually mean by performing credit. Credit is one part of the word and performing is the other part of the word. Maybe I can kick off with Bala, with yourself, just to lay the groundwork of what do you, when you call performing credit, what do you mean by performing credit?
Okay, let me thanks for inviting Ravi. I think one does know when you get introduced by someone else. So thanks, Ravi, for that. So see, I think the way I look at it is there are inefficiencies which are created by the system needs regulators, the system needs like certain processes, certain norms, certain regulations. So when that happens, like it opens up inefficiencies. Let me put it this way. Banks, like I think, when you have small depository holders money, it's important that there is a framework which is given by RBI, and then you are mandated to follow that. It's needed. But it does open up like areas in which like they cannot do business. For example, banks are comfortable giving cash credit or a fixed asset term loan, but whereas they are not comfortable in doing anything other than that, because like, and rightfully so, that's the credit they should be underwriting. And like, there's, their poorer cousins, NBFCs also have the regulations, and in which like I think most of them, because like they think they could be sitting in Bombay or some other place, they could, every credit could be productized, which means like I think send me ABC and I can tell you like what I can give you. I think that's kind of overdone in some of these corporate credits. So it's predominantly because of these inefficiencies and structural things. I think, there are bankable credits, what I would say, I think risk-worthier credits, but otherwise non-bankable by banks and non-NBFCs, and which can be tapped up by rest of us. I think I would put that way, saying that I think probably those credits like which are, credit worthy enough to be underwritten, maybe after some time like everyone else in the queue, which is the NBFCs and banks, could discover in some time, which could be 12 months hence and 15 months hence or 18 months hence. I would say, I think that inefficiency in the market, which opens up and where the credit opportunities are available as a performing credit. I think, maybe I don't know whether I've answered it, but that's the way I look at the way things are.
Irfan, do you agree or you want to add something or disagree with it?
Well, I'll just add on, but because one is looking at issuers who are not credit worthy enough for banks and NBFCs, but in performing credit, there are also end users within issuers which have already banks, already NBFCs, they are already sharing a lot of credit lines and well banked that way. But there are many end users or opportunities within those issuers itself, which also would be open to funds or even large NBFCs per se. So a performing credit opportunity is one which is available to private capital like us, as well as large NBFCs who have some flexibility in terms of structuring. So I'll just kind of add on to what Bala said, that it's a little, I would look at it in a little bit more broader sense, that even excellent companies which have very good debt EBITDA ratios, have very long operating vintages, there could be some issues which might not fit into this typical banking template, right? And at that time, you provide that additionality by the capital and the structuring that you're able to do, and then make the company tight through that phase, and everything remains hunky-dory for everyone who's involved in the debt side of things.
Basically, you're saying is that anything which may be not, everything doesn't have to be X bank. It is bank plus something in that particular space.
Maybe at that point in time, banks do not have a favorable look at that.
Or that particular requirement may not be.
That's what I said. I think, it doesn't mean that I think no bank is giving and we are giving. I'm just saying maybe at that point in time, banks have a different outlook. It could be many reasons, like when you give COVID loans, with 20%, 10%, 20% as a credit guarantee by the government, there is no enough incentive for a banker to write any other credit, am I right? So they can live only on that. So I think that's where your opportunity comes.
Shikhar, what do you think?
I think Bala and Irfan has covered, but let me preface when I think, and I have worked in a commercial bank as well as a PE firm, and when I look at it, credit, I think in India we very loosely say it, credit actually. So performing credit is something to a corporate which may start at 7% going up to 20% maybe or 25%, you never know. But there are certain portions of the loan which can be given by the banks actually, because in India the good thing, the regulator has a very stringent kind of end use issues. So if the end use issues are something which is not appropriate, like if you want to purchase shares or invest in capital market or something like that, those end use money you cannot borrow from bank. So that piece of performing credit, if you look at it, is serviced by mostly the banks in India. And I think what we are seeing today with the wave of performing credit, it's become a lot of noise, and that's the reason we are sitting here, is because earlier this entire market was catered by the mutual funds and NBFCs. Over last 3 years, we have seen substantially changes in the regulation as well as the investor requirement in each of the buckets have changed. And that's the reason people have looking at alternates credit AIFs, more looking in the performing credit, and it serves two purposes. Bala rightly says, banks would like to do some, not would like to do so much hard work, whereas an alternate credit AIF, we will do about 5 transactions or 6 transactions in a year. We will do a lot of deep dive in each of the transaction, maybe get comfortable, which banks maybe after 1 year will take it out. Or there can be a transaction which Irfan highlighted, where the end use is something not a bank appropriate end use. Those deals historically used to be done by NBFCs and mutual funds, and now they are coming in the lap of the performing credit funds who are looking at it. So these are good companies, but the end use is something what banks cannot finance. Tomorrow, if I can say banks are okay to finance this kind of credit, I think there is no alternative asset class out here. Banks will be doing this work actually.
So, if I can just correlate with that, Irfan, your point as well, and what you also mentioned, that at that point of time, that maybe not be a bankable credit, but is still performing credit from a good company, there is a difference in yield. So, the yield differential comes in, why? Because the underlying company is the same. Yes, the situation may be a bit odd. So that everybody knows that situations can give you a bit of a risk premium compared to not just the rating of the company itself.
I'll probably illustrate with an example,
Yes,
if
please,
that's
please.
fine. So there's a company that we saw and we've invested in, which is in the logistics space, right? So when there's a logistics, they are in the trucking business. They transport a lot of over-dimensional cargo. So you would see, all these windmill turbines, all of these things on the road. You see these large trucks. That's what they transmit. Now the working working capital cycle of this is quite long. So by the time the truck reaches the destination, going at 10 or 15 kilometers per hour, and then the bill gets raised, and by the time that gets financed, there's a clear 100 or 120 days that kind of goes past. So a bank can finance as per its working capital 90 days to 120 days, most of it. Beyond that, the banks would not look at financing that receivable. Now, because of COVID, this company's receivable cycle increased even more. There's no counterparty risk. When I say counterparty risk, the people that they're supplying to, they are all AA plus, AAA kind of guys. But just because of the fact that the receivable cycle has extended, banks are not funding those receivables which are 150 day or 180 day plus. What do we do here? There is no issue. The company is not defaulting. The company is funding all of it with equity, right? Now, because of this situation, the company is not able to grow. Now, what do you do here? Either the company would have to go and raise equity, or talk with the banks and make them do something which they've never done before, or stagnate, right? So this is where something like a private credit fund on a performing credit fund is what we can do, right? We know that the counterparty risk is nil. We know that this company has 20-25 years of operating vintage and experience, not had a quarter of losses. So we are saying that, okay, fine, we'll fund you, use that to grow, but we will be secured by the receivables which are 150 and 180 days. So it's a very simple, when you describe it, it probably seems across very simple, but to get this trade done in a conventional banking system is extremely difficult. So just a simple example, I thought.
But was there a yield differential, what bank was lending and what you were lending?
Right. So for a bank to be financing this receivable, they would be at a 10 to 11% in a normal 90 day. This is a BBB rated company. Because we are doing this, we adopted a weighted average approach, right? So we are saying that we are financing the overdue receivables, but in a way it is sort of bridge equity for you also, because you're not diluting. So we are providing in some sort of a higher risk capital to you. So we were able to get 200-250 bips above what the bank lending rates are, which takes you around 13.5 to 14 odd percent sort of a return on this opportunity.
In a house view of sorts between three of you, what is that band that all of you play in, on the yield band? The most, I think the common question people try to identify different types of credit in the Indian market. So what is that band you would like to play with, Shekhar?
So I think when we look at it, there are two kind of risk premium we add actually. One is the credit risk, and personally something which I add is the scarcity capital risk, because the capital which a alternate fund can provide cannot be raised from a traditional banking route. So it's not that the entire thing is a risk, credit risk. It is a mix of credit risk, but a premium you can charge because this capital is not available. As Irfan said, this capital is not available from the banking route. So one is a credit risk is charging, plus there is a premium you can always charge the guy because this is I am giving this capital. So if you look at it, this where the bank world or mutual fund stops, which is somewhere in 10-11 bucket, and it goes to about a 16 in my mind actually. Maybe people may have a different view, but because beyond that, the higher the risk, higher the return. So the same philosophy will flow. So at a 10 to 16 is where each of us will play. Maybe we are trying to see if we can get in a blended basis a 14%. Once I do the full portfolio construct, some deal can be 12, some can be 16. But beyond 16, I believe the credit has a different perspective altogether. I am not saying they are bad, but it's a different risk appetite. Somebody should look at it.
Bala, in your case?
Yeah, I think our expectations are a little more. I think I said this many years back. Wherever there is no direct flight from Mumbai to that place where the investment entity borrows, we get another 100 basis points. So that's where I would end it.
There will be a lot of tracking of flights and borrowers.
Yeah, so I think first thing I do is there a direct flight from Mumbai? Then I think you have 150 basis points like premium, because they don't take the flight that easily and come travel then go. I think I'm not trying to make and that's the point I'm making is the starvation of credit is much bigger issue. Okay, so as underwriters, I think as we discuss, negotiate, we need to keep that in our mind and say I think this is not a productized approach. If I can get 150 basis points more, why not? So I think that's how I would put it. I would not want to put it in a band, but I think broadly what they said is right. But I guess I think I just want to I have a thesis on higher risk but expected higher returns. Correct. So you're not guaranteed to have the higher returns. So I think wherever you can, for the same risk, if you can push that 50, 100 basis points more. So I think most of our credits in tier 2, tier 3, I think we are able to get that 150 basis points more, but it's not easy to do. That's all.
Irfan, would you have, as a fund manager with multiple funds, a minimum that you will lend with?
You mean in terms of yields?
For example, when you are lending in any of your deals, what is that minimum rate of yield that you get from your underlying? Is there a minimum cutoff that you will not give, or is it always a spread between the AAA or AA kind of papers?
So I have a different answer to this. So our philosophy, at least with the firm I am representing with the AMC. So what we do is that our idea is to demystify this space between the 9 to or 10% to about 16%. So which is how we've ended up, for the AUM that we manage, we have 7 funds. So our lowest price deals we have been doing at 9.5, 980 also, and we've done all the way up to 16, 17% also. What essentially is missing here is that an investor is not able to actually understand what risk he's taking, right? There's a reason why there are credit rating agencies globally. Fundamentally speaking, debt is supposed to be simple and easily understood, which is why a regulator itself says that, okay, fine, you're those 3-4 guys who are supposed to say something and provide an opinion, and then you end up investing, right? So it's supposed to be easy. Now, the minute you start moving away from there, there's a lot of confusing, confounding, and then you start looking for people who will take you across to the promised land, right? And that becomes akin to an investor ascribing an equity risk to it. So the way to expand the market and get more people is to break the risk down. So which is why when you ask me about which yield I would give it, I would be present at any yield. The idea is for me to do something which current capital pools are not doing, which is mutual funds, which are large NBCs, which are banks. What they are not doing, I'll do that till a particular risk threshold, and beyond that there are other pools of capital which take care of the risk. So I won't really.
Can I generalize, as just to sum up this part of our section, that anything which is beyond the purview of MFs or typical lenders
Absolutely.
falls under the the bucket of performing credit as long as it is performing, and at the rear end of it they can be distressed asset as well, which is a separate asset class, so we are not touching there. Now there's a new concept of distressed performing asset as well, so now there are versions of it, but anything which is performing but beyond the scope of banks and NBFCs which I talked about. You touched upon ratings, and I like to like bring Bala into this.
Yeah,
I mean, I think for everybody who
tactically.
wants to who wants to invest in fixed income, you know, everything starts from rating, which is good and bad. Good in the sense that when you're doing AAA or AA rating and you've got typical diktats around what you can do, can't do, ratings help, right? But when you start going into this performance credit space, obviously then things start becoming a bit loose, because we're talking about BBB, A minus, or sometimes even below those kind of ratings. So ratings do play a part, but that's not the whole and soul. Bala, your
Okay, so in fact, I insisted that you should ask this question to me. So I think I just thought I will tell you that. The reason is that I think, they do play a role. I think there is nothing, wrong about it. There are shades in which they give the ratings, which is good. But the point is, like, if someone pays, he's a AAA. If someone doesn't pay, like, it's a default, correct? It's as simple as that. Okay, but you can have, like, I think others. The reason I say this is, I think I'll try and give an anecdote, which I was part of. I used to live in Singapore, many years back. So there are a lot of used to be debt salesmen used to come and pitch, people who sell the papers. So one such guy came and told me that I think, there's a country called Iceland, and then he said, I think, the country is a AAA, so I'm from Madurai, not from Madurai, like down Madurai. So I think I didn't have ever heard of this. Even today, I don't know the capital of this country. So, I didn't bother to. He kept on saying there are 3 banks, Landix Bank, that bank. So all of them are AAA. Fine, great. So that point in time, I used to live in Mumbai. I moved there. So typically, my brought up, how big is the city? So how big is the country? He said 300,000 people. So I was just looking at myself like Andheri West, where I used to live, had more people. So I said, okay, great. So I asked him, if, let's say, like, the country could have maximum 30 plumbers, good plumbers, 30 plumbers. If all 30 of them have a conference, and if there has to be an unfortunate incident, that country would have a plumbing crisis, leave alone financial crisis. Okay, and that was a AAA. Okay. And when it collapsed, they had to give only 5 billion back, and they had to borrow from UK. Every time, like, I met a rating guy, I think fantastic people, highly academically driven, very good people. I could still figure out what is that, like, I think, stable outlook and negative. I asked them, boss, you tell me what is this stable, what is this outlook, and why it is negative. I haven't heard one guy, like, I think, explain it to me. Within that grade, so you've got 9. Within that 9, you've got 3 each. 27, I think, it's good alphabets, almost similar to English, alphabet. So to me, I think, it's a kind of a game, like, which is being invented by someone, which is being played, now. What it does also, it makes people lazy. They don't look at, see, I think, we all grew up as a relationship credit, am I right? So I think we know the guy, we couldn't have the access to the kitchen, which club he went to, whom he played with. Like, I think, that's the kind of, inputs we had. So here is someone looks at, okay, BBB minus, and that, okay, give money. And that's kind of lazy, am I right? And that made the bankers lazy, because, like, I think they didn't want to get caught by CBI or CVC. They said, okay, I want an external chapa. So this is like outsourcing the credit to someone who has never done even 1 rupee of credit and recovered in his life. Okay, not even 1 rupee. I have not seen one. On top of it, one guy asked me, what is drawing power? And he gave a rating and said, sir, what is this drawing power? So I think some of you, I think, please go and read what is drawing power in, when it is a working capital. So, it's good. It gives you a, large mark. I think, there were Kazakhstan banks in 2007, the kind of ratings which, like, I think some of these guys gave. So you can go Greece before it went. Then they will say, sir, I think we went wrong only once. So I made a murder only once. I killed it only once. There has to be accountability. Like, I think you can't take fee from myself, Manish, you would appreciate, and give a rating for myself, correct, and which is not conflicted, and which you will sell it to others. We need it, but I think the current way of doing things is not the perfect way. So I think If someone comes in my office and tells this is the rating, I just keep it out and say, okay, now tell me like who's the promoter. Rating, like I think that's for mutual funds.
Which actually brings to the next question.
Yes,
how
sir.
do you approach investment when rating is out of the picture?
Which is easier, you know, which is easier in the sense like I think then you talk about business, then you talk about promoter, then you talk about his suppliers, then you talk about his purchase, then like where does he bank with, which all banks he moved, whether like ROC, like is there any case which is pending against him, like I think you can just go on and on and on and say like I think get a file, like I think look at all these things, like which club he goes to, and then fine, and then like look at I think whatever you want to know, like which is otherwise publicly available will be there in the rating agency report. Correct.
Right.
So I think I'm not saying rating is not a must. Rating is a must. I think I like that. I think you need a third party benchmark, but the current set of people, the current set of crop, and like I think the way they do the rating is the most obnoxious one which anyone could see. And this is my view. I could be completely wrong, but I think, just to tell you, I have an IC member who is a ex-CRISIL guy for 12 years. So we have this discussion every IC meeting. You will keep on telling. So I think, so once like I think I just told him that this is a BBB minus by CRISIL. So I said like if he wants money in 7 days, it's 18%. Tell him that. He actually borrowed at 17. We could give money in 10 days. The spread was telling like I think 12%. So I think this is it's good, it's done, but it makes people not knowing credit.
Which then Bala is telling us that in this space you need to have special expertise to be able to do investment in that space. The normal way of fixed income investing, which is fundamentally based on ratings, will not happen. Which actually, if I can ask the other two fund managers, for example.
You please differ with me as much as you can. Otherwise, people will walk out office, walk out of the room.
It's okay. But I think, how do you approach it? Because everybody knows nothing comes for free, right? And maybe you have investors sitting in this room or people who want to make a career in that space. It's not easy. It's a lot of hands-on stuff. It's not just looking at a rating, and with due regards to mutual fund managers in the room which do look at ratings because they have internal guidelines to look at. But I think in this space, what are the processes which actually people like you or fund managers like you actually build in to make sure that you are investing with the right risk premium, making sure the yields are conducive to the risk you are taking, and as Bala mentioned, there is a process of looking at a 360-degree kind of appraisal. In-house view, how do you approach this whole investing?
So I think one of the key thing Bala I think highlighted most of the aspects, and that's the kind of a playbook somebody has to actually follow in lending, whether it's a performing grade or distress or any grade actually. I think rating is a good external benchmark. I think unfortunately in India we have been trained for last 20 years to see rating rationals. So we can't simply say that I don't care for it, because tomorrow I invest a fact sheet, people will ask what is the rating. That's the first thing I get asked. So rating is there actually, and that's the thing we have to live. But we also keep that aside, and the broader thing is how do you do a simple credit analysis. It's a very commonsensical approach. We don't need to do very exotic things actually to create it, because people do speak about a lot of structures and everything. And one of the things I joke is that it's like if you create so many structures, it's a Chakravyuh. You get in, you can't get out. So you need to have a simple thought process. Who is the promoter? How has been his track record? So in like my statement, we have put a 10-pointer checklist whether this 10 points are do's and don'ts flow through or not actually. So it has what is the promoter in India? Whether you do debt, equity, anything actually, you do a business, you need to know the guy. How has he behaved 20 years back? Like has Sajjan Dindal, who went to CDR in 2002, how has he behaved over that? I'm not saying ups and downs will come in company's career or promoter's career. The most important thing in a difficult situation, how has he behaved at that point of time? There are people who are good at good times, and in a bad time you may not get into his office. I have been through people in distress where getting into his office looks easy, but we were always worried, can we get out of that office or not actually, because it's going through 2 lifts and some doors and everything, and you really struggle actually. I've been through in Gurgaon actually, and it is a really worrisome thing. So you need to see how has the guy treated, like in a good time he's offering you a coffee, in a bad time can you have a conversation across, because my distress experience tells me like if something goes wrong, God forbid, the best recovery always happen when it's a win-win situation. Definitely if you get a rogue guy, that's a blunder, something I have made because I have selected a bad promoter, which is the most important thing. Then you come to the cash flows, business, what is his pedigree. There can be industries which are sunset industries which don't have a future beyond a point of time. So you need to have that kind of a thought process whether you can understand that risk or not. and what kind of cash flows are there actually. The most important thing in India, like we look at EBITDA actually, and one of my colleagues in IPRU had put a, if you discuss EBITDA, please get out of this room actually, because there is nothing called EBITDA. EBITDA, after that you have tax and you have capex and you have working capital. So tomorrow if your business has a lot of capex and lot of working capital requirement, you don't have a free cash to service debt actually. So I was in Apollo earlier and there was a automobile case, we were looking at it and we were showing a debt EBITDA of 5 times entry, it was looking fantastic, and our CIO, he told us just remove EBITDA minus capex and then show me the ratios. Suddenly the ratio doubled, because at an auto component player, you are a kind of a slave of the OEM, because OEM wants to spend you so much, you have to continue to be on treadmill to spend that. Absolutely. And after that, if you look at it, you don't have free cash. So suddenly on a debt EBITDA, it looks super good, but suddenly EBITDA minus capex, you are really struggling how this company will service the debt, because a lot of times this looks 3 times, but suddenly after removing working capital and everything, it looks 6 times. So you need to see that. And the more important thing in performing credit space, when we look at it, we have a big list of don'ts and like 4 or 5. We don't look at distressed companies, companies which have been in NPA, they want to look at OTS. It's a pool of capital which distressed capital can look at it, but not in the performing credit space, something we don't want to do it. So our one big check is that, has the company ever defaulted? Now there can be default for 2 kinds, one is COVID, everybody went through a problem, you need to work with the promoters, but if there is an intentional default, again is a promoter issue. Then there are certain sectors which we believe are always good for the promoters, not good for the any other stakeholders. So if you can take something like an EPC company or a government business company where you have a sole client as government, you can't fight with it. So you need to pick your sectors also and understand in this business, does he have any USP out that, or he is dependent on one guy and you are just a kind of a converter in between, and you will just make thin margin, and in a bad scenario you will get squeezed out actually. So I think these are very commonsensical basic things. If you just put out in a simple checklist and see whether it fits in or not, and definitely you can always predict cash flows and everything which is required to be done. I am not saying modeling should not be done, but again you, in these kind of companies, we don't look at growth. We are not equity investor that I am looking at tomorrow the multiple will grow X, Y, Z. I need to see if this company 3 years back has made 50 crore EBITDA, can they sustain for 50 crore, and am I good at 50 crore EBITDA or 60 crore EBITDA in next 3 years or not. So I think definitely a scenario analysis is very important. So a holistic perspective is required, but the most important thing in India, I believe, is the promoter.
Irfan, I'm sure there is a combination of numbers and subjective, some parts. I mean, for example, he mentioned, or he also mentioned, which club does the promoter go to? These are all subjectives. You can't quantify them. You can just maybe write a report around it. Internally, you also have a combination of those, or you are purely on numbers?
Yes, it is always a combination. That's where the nuance start coming in, right? Because if you really look at what Shekhar might like, Bala might like, and I might like in a company, 9 out of 10 things would be same.
Correct.
Right? It won't be very different, and it's something which everyone can pick up in 5 minutes. It's how you manage it in an environment where, first of all, common sense is not so common. We all know that. But other than that, there is a aspect of asset deployment, portfolio construction, managing investors along the way, looking at yields. For example, today, if I'm looking at a 14% yield, which seems very high risk to you, but it doesn't make sense to any dollar investor sitting out of India, right? A 14% rupee yield makes no sense on a hedged basis because of what a currency happens. So many layers start building in, at which point you would have to always play a balance of risk argument, whether you are going to go only by 5 parameters, or you're going to add something. So internally at in my firm, what we do is that we try to have first a macro gatekeeping, right? We first understand the interlace, that because when macro whipsaws, it eats micro for breakfast, right? So we make sure that the macro is conducive, and once the macro is conducive, one is for the country which we can't do anything about, but then for sectors. Yeah. So right, so we know where to go. Mostly in sector macro, not global macro, but sector macro. So we make sure that's fine. Once that is there, we pick up companies which are the companies who we would want to work with there. So if you're looking at, for example, renewable energy, you would know that, okay, fine, these are the 10 companies which are credit worthy, right? Then it's a key aspect of performing credit is that not everything comes to you on a plate. Actually, nothing comes to you on a plate. Its discovery of a credit is the most time consuming, complicated exercise here, right? So we spend a lot of time doing that, and then comes the analysis. So when you're doing discovery, it is like it is kind of an iterative process with your analysis itself, because all these companies are not raising money from mutual funds. They are not out there saying that we want money, right, at all points in time. So it's about being right place, right time, and then you start analyzing it, right? So our analysis, whatever we do, is completely in-house. So all the points which Bala was saying in terms of the soft checks with the promoters, we look at it in a, maybe we will not have the same opinion, every person has a different opinion about the same new data point, but we look at that, but post that all our due diligence is in-house. So we are extremely particular about not outsourcing. So Bala talked about ratings, credit being outsourced. We are extremely particular about not even a particular part of our due diligence being outsourced. So even if it's a financial due diligence, we don't go to the big fours, we don't go anywhere out. We make sure everything is done in-house, and we do a 360 all in-house. So that's probably something which we feel will hold us in good stead, because when things start going bad, again trying to have that coffee with promoter, what Shekhar was trying to say, unless you've met him every quarter 2 times, 3 times in events like this, and not just him, but 3 levels below him, different people in an organization meeting, how will you make sure that you'll be able to collect information? Because that guy can just say, I'm out of the country for 20 days. If you have been having a chai discussion and a big relationship call, it becomes very difficult. So we make sure that we are connected across the level. So n-3 tak, we make sure that there are connections. Understood. So that, why I'm saying this is that underwriting is an original sin. You can go right, you can go wrong. But a key aspect of performing credit is, and the most difficult, is actually monitoring. So more than 50% of our time gets spent in monitoring.
Which brings me to just a thought. This space is not easy for many investors unless you have that team backing up or you have experience backing up, because some things can only be learned by experience. Everything is not a checklist. Beyond the funds who are investing in this space, who are the other investors who are currently you see active in the performance credit industry? I mean, anybody who can answer.
So if you look at like last 10-15 years, the foreign banks have been the most active, if you think of it, be it Deutsche, Standard Chartered, Credit Suisse, Barclays, Nomura. So they have been the most active in this space because they are governed not through the banking license, but they do have their FPI licenses through which they can do these trades, which they have been very active. Then there is a bunch of global investors who are coming in. There is a bunch of Canadian investors who have invested in a lot of infra assets or infra yielding assets actually. But this asset class today as we speak, and as Irfan highlighted, our Indian returns are not appropriate for any global fund to invest in India, because the risk return reward as compared to what you are getting in a quality company in US or UK, we are not getting the same desired return in India actually. But still the banks who have been historically present in India, the foreign banks, are one of the most active participants as we speak. And definitely as a bunch of this AIFs who along with us who are coming in, I think we will eat away a big market share from them, and the market pie also will grow accordingly.
And some of the foreign banks are no longer there in the picture. Some of them are.
Yeah, I think the people who are relevant are still there.
Still
there. Unless the capital squeeze comes and they don't have capital to put money in India,
then you have an issue. Brings us to retail now. Retail and credit. So the elephant in the room was the Frankel Templeton issue which happened, because then after that credit became a very bad word to take in many client meetings. Retail and credit, do they go along, or was there some learning from that episode, or there is something which could have been avoided? Because I think that question, anybody who is increasing risk in their portfolio, asks the first question, what went wrong? Maybe we can spend 5 minutes on what went wrong, because that was not a performing credit fund, but even then it faced problems. So Irfan, maybe with you, what was the issue?
Right. So being in an MF myself, so I've been through that very difficult phase when the entire credit funds kind of shrunk from 1,20,000, 1,30,000 odd thousand to about 20,000-30,000 crore what is there today. So 50-70% gone in a very short time. So first I would like to place one thing on record, that the Templeton incident is not a credit blowout. It is a product issue. So as I think previous panelist Shankar was talking about, that liquidity is what kills a business, right? So if I have a 100 rupee claim on a company today and you do not have it, then you are a defaulter, right? regardless of whether you have 10 crores in your bank. It does not matter to me, right? So is the same thing happening to a fund. So when there is an open-ended fund architecture, right, you would not be able to meet. So if you ask me to become a bit more critical, I would say that Templeton failed in not providing a crucial part of their product promise, which is liquidity to investors at any point in time. But that's a product issue. If you look at the companies that Templeton had invested, in my previous organization at Birla Mutual Fund, we bought some of these papers at extremely good valuations. Those papers have even matured today and have yielded much higher than what their YTMs were. So just wanted to say that, for those of you who might not understand or might not have appreciated it enough, it is not a credit blowout, right? It's a product issue. What that led to was that people started saying that the product issue is a credit issue, and because of that we would not invest in credit, right? Now when AIFs are coming, we are solved for that product issue, right? So there is a close-ended structure that all of us are working in. That's the framework we are operating in, where a person who comes in would know that, okay, fine, there is liquidity would not kill the fund per se. Then what is left is broadly your credit risk, which is the only risk that we end up taking, right? So for retails investors looking at credit incrementally, as long as you understand, and this applies for credit or equity, just invest in what you know and what you understand, right? So if you are able to understand in a particular, there's a AA, for example, Shriram City Union Finance or Shriram Transport company, which everyone knows, and being in Chennai, I mean, everyone knows this, right? So if that company is coming out tomorrow with a bond, you would be able to have a strong opinion on it. But if there is a XYZ company, which maybe all three of us know very well, coming for a retail NCD issuance, probably that's not something that you would invest. I would still advise against it. And I'll end with one data point. For lack of a better benchmark, I'll have to go to ratings. So if you look at from A to BBB, if you move, at A, the default ratio for a 3-year period is around 1.3%. The minute you move to BBB, it becomes 4.5%. So, and beyond that is unrated. So any fund manager who's able to manage a BBB space and beyond needs to add an immense amount of alpha, because the incremental spread from A to B, BBB, is only about 300 odd bips. So if you're allocating equally to A and BBB, you would end up making the same sort of returns. So which is why once you move down the credit curve, I would still today not say that retail investors should be looking at those investments. They should invest it with people who can meet the promoter, have coffee with the promoter, do all of those things which Bala was talking about. Probably invest through them.
Bala, sorry.
No, I think see, I would not want to comment on that particular episode, but I think let me look at it this way. What are those credits like, I think, which were very unpopular? Amtech Auto, Yes Bank Promoter Finance, and ZTV SL Group Promoter Finance. I think we can all call out. Okay, so I think I'm sure I just gave these names more for educational purposes, nothing against them. And whether those transactions should have been accommodated in a fund where someone contributes 1,000 rupees as a SIP, it's an ethical call. Okay, to me, it's an ethical call. And how they were done, I think people know it. How I think this is the transaction construct, and can we get this kind of ratings? Is it possible to? I think let's call it out. I think I'm sure some of us would know it. So I think the ratings were so put covenants and said I think this is how, and you've done it, and you have to face that. So one thing I agree, it's a product issue because you didn't have time to resolve it because it's open ended, it was running down. But also the issue was there was too much money to manage, and you had to do certain things to get that alpha which you promised. So that's where the real issue comes in terms of how, if you have too much of money, I think you're only long only, you still need to keep finding those opportunities which also puts pressure. So it's an issue of all combinations. I think one is market issue, product issue, and then I think there were systematic issues of how this money could be. I think some of this I think, see, they will continue to be there in some form or the other. They would come. Okay, that's what history teaches you, that's what market teaches you. They will keep coming, I think they would be sure. But I think regulator would learn, regulator would become more smarter. Like I think one of the reasons why like we thought this product, this area would grow well is, when a regulator said like I think, you can't be doing this kind of credits like I think in MF. So it has to be in AF. Okay, so that's how AF's growths are happening now. And within AFs, then they would figure out like I think what is right and what is wrong. So I think these will evolve. But what, to me, I think that was an issue of like I think product is it was an ethical issue too. I think let's be sure about it. I think it was an ethical issue too.
I'll take your experience, Bala, with meeting the HNIs and the ultra high net worth space as well as part of your fundraising. How much of allocation do they have, or do they understand the market, let alone the retail part of it, even the high net worth investors?
See, they do understand it because like I think, see, one of the things which we have done is we never had anyone in between as a wealth manager or an advisor. So every investor of us, like we have met personally, spent time, and also spent time like every 3 months, once like reviewing them. So they all know what stuff which we do, am I right? So they probably put you one down to, I've got a couple of them, so I can't use this word, but I think one down to a roguish investor and say, okay, boss, this is the stuff you do. So they all know. But like even from our side, we say, I think don't do this more than this. Okay, maybe a percentage, don't do more than this, because I'm sure like I think there are much bigger options. So I think I would put it this way, like I think, I think he substantiated what I was making. So between A to triple B, it's only 2.5 basis points, which means I think, those many shares are not really required, am I right? But once you pass that, he also made a point, which is like, I think you need, the alpha has to be substantial. So what, like it's 2.25 times of your risk-free rate, at least. So that I think, if like 30% goes away, you still, get away with something. Otherwise, what's the point in doing it, correct? So, when you do that, when you explain to that, like I think, it's a tough job. Like I think all of us have the responsibility of going and creating this market. Telling them again and again, it's not easy, it's risky, I might lose money, but I think I would not lose money on a point where I, knowingly, I think I overlooked certain things. That's something which we can promise. But these are credits like which are expected to behave like this. So I think it's it's happening. I think it'll happen. Hopefully, I think with all these young people, I think we have got a great inflection point coming. So hopefully, I think at some point in time, like this performing alternate credit would be as larger, as like I think other than liquid funds, like other may not be like big in gilt, but I think it could be on par with some of these corporate bonds, like I think kind of issuances it could become.
If you actually look at the investor options today, you have liquid fund on one end, and then you got the new age target maturity funds, which was spoken about in the earlier, giving good yields, and you can lock in your yields.
Correct.
You're getting 7, let's take an average on that. There's always an expectation of people to have some risk premium, right? Whenever you're taking entry into a higher credit space. Now, everybody has a different way. It's not a science, it's more of an art, and it's more of a comfort zone, I think, what we have understood. What do you think this asset class can provide? And taxation, naturally becomes the spoil sport to that extent in this particular space. So if you're a corporate is investing with you, has a very different flavor of post-tax. When individual investing or ultra high net worth individual investing is a very different ball game. So have you faced that challenge in this industry when you are convincing your clients? Does that come as a discussion item, or should there be anything, any kind of a support from the regulator on the taxation side, which mutual funds
I'll put it this way, like whenever taxation comes into picture in conversation with investors, I tell them, sir, I think we leave it to the government and chartered accountant. Okay, we are less experienced and privileged people to advise on that. But having said that, tax is something like one can never control. For example, I think MLD, which it's a product like which is built, or like I think a scheme which is done on capturing efficiency and inefficiency of taxation is not the right way to look at it. I'm saying like this is what I can get it. If there is an appetite for you, like I think then do it. Otherwise, don't do it. Okay, now the corporate tax rates is 25%. So instead of doing it in your personal name, you can do it in your investment company. If you have a MAT credit, because this is an interest income, like I think you can knock on using this MAT credit, you can knock on it. Not everyone would have it. But there are people who have all these things. So I think, that's where I think it becomes smaller and smaller. But, I'm more and more saying, like, thinking that, like, tax is something which we should stay away. Okay, tax efficiency, like, for sure, like, I think any government, whether the current government comes back or any government comes back, I think taxation in this country, I think, is sorted out now. They are going to chase people. They are going to get every 1 rupee out of everyone. Okay, so there is no way, like, I think we can get away from that. So I think we can only do our job, leave the job of collecting the tax to the God and government and the child accountant.
Shekhar, what's your experience been?
I think just before coming to tax, one point I think in India we believe like credit is, suppose I have given $100, it should come $100 whether I have given it 4%, 20%, 15%, it should come with full return. So credit I can't expect a loss, and that's I think in education which need to be done, like based on past credit history. Let's assume with a credit loss adjusted, what is the return? Because you can get a loss in this asset class. Like in gilt, like as the rates go up, you are incurring a loss. Like I have seen people in equities, they lose 50%, 70%, no complaints. Yeah. Credit one loss, like it's a very, so I have done analysis like if 2 deals go off for me or certain recovery, what would be your return actually? Because people ask that and we told this is what the outcome would be. Because that's a fair assumption and fair thing to ask. Assuming that if I am giving money at 14% and people think is a ICSI guaranteed product, then the entire world will be lining against us to give the money actually. That doesn't work. So one is that credit loss has to be a part of the thing. So when investors look at it more specifically from an asset allocation perspective, they have to assume in credit you can incur a loss. It's not that credit is like 100% assured product. Tax, like I fully agree with you, like MLD is pretty much a tax arbitrage product. We don't know how long it will continue. We don't buy that thesis much. We should give what an absolute return I am giving to my investors, whether it's X, Y or Z. After that, it is investor prerogative, how you want to look at it. The only thing we can bring is that how much the management fee efficiency we can bring in the place. That's the only thing I can give from my side. And I need to be adequately incentivized as well, so that I don't have a enthusiasm or incentive not to do it managed properly. So I think other than that, I think tax is definitely investor, but we have also seen like in our fund more than 50-60% of money has come from corporate vehicles, which means investors do have platforms or vehicles through which they know that my tax rate can be lower.
That's a very interesting data point. I think if you can, I'll not call it evade, but avoid tax, why not? I mean, if that's available under your tax guidelines.
Tax planning.
Tax planning, yeah. So Irfan, you manage 7 funds, right? So you'll have different types of investors coming into has that come into the discussion, or have people said no to you basis taxation? Has that ever happened in your meeting the customers?
Right. So one is an instrument level efficiency or tax arbitrage which MLDs sort of offer. The other is the vehicle itself, which in a different forum, all of us will be vehemently fighting for parity with MFs, because for those who might not be aware, MFs have an indexation benefit that kicks in for debt mutual funds, right? So your taxation, kind of effective taxation becomes much lower than when you go with an AIF, where you have full taxation applicable as per your income tax slab, which usually is in a 40% range. So with that background, what happens is that the risk that we need to take to give you a ceteris paribus return versus a mutual fund goes up. We are primarily risk managers. So the issue is the return and the risk, where we are trying to say that, okay, fine, to give you a 10% risk, return, I would have to underwrite somewhere around 14 odd % without forget management fees, but just gross return I would have to write somewhere around 14 odd %, right? So that 200-250 basis points additional is usually the bone of contention with investors, right? So what we have been able to do, so the reason why we manage 7 funds is that we've attacked this problem in such a way that there's a pool of capital chasing a specific form of risk. So for example, a family office would chase a certain sort of risk. An ultra high net worth individual who's having long term money would chase a different kind of a risk. So on corporate treasury will have a different sort of a risk bucket, right? So to make sure that there are products available, just like how an AMC does, we this low duration liquid corporate bond fund and so on. So we try to make something available for almost all investors in this high net worth individual and category 1 CR plus category. Now where we've been turned down per se, I would tell you, is largely from international investors, which is again the same point, right? Like when we started building the product about a year back, at that time, $7.5, $7.75 return, which translates to somewhere around 14 odd percent INR, 14 to 14 and a half, was a very nice product where you can hedge and everything and so on. Now that product, the ask has now become 9 odd percent dollar, plus the increase in hedging cost. So technically what people are expecting for performing credit is an 18, 19, 20%, which is a distressed sort of a credit in India. So there we have seen a complete sort of, I won't even say slowdown, it's just choked stop. And these points are what the equity market largely is not seeing, right? Like what's happening in the junk bond market, what's happening in the performing credit market in the dollar space will have cascading effects here. So I'm just trying to say that in India, people are still very happy. The investors, the ones who we are talking with, the family offices who look to allocate, the ultra HNIs, they have not said no because of taxation and so on, because again, they have multiple vehicles through which they can manage taxation. International investors doesn't make sense at this stage.
Which, there is one space we get a lot of debates around, that in performing credit, should venture debt be part of it, and should distress definitely is not, but is venture debt part or to be considered as part of performing credit? Any ideas on that? Because that's a hot topic debated in multiple platforms these days. Anyway, Bala, we can start from you.
Okay. So, frankly, I have very less understanding of venture debt, so I think I should clear that. So, the reason I am saying this is, I think it's structured in such a way that like the money comes in on the day when the equity investor comes in. And then like it's a portion of it. Let's say 500 rupees comes in, like probably 20 rupees goes in as debt. The popular philosophy is that I think it gives a runway for them, like I think for them to grow. In a way, it's it solves a few more months of, because they amortize from day one, so it's a 36 months product. So I think it's a very productized approach of writing credit. The credit diligence or credit underwriting is dependent on who the VC investor is, rather than like I think on the company itself. So it's another vehicle of like I think giving additional money for the new age firms. What I think it is evolving. I think it has done a good job. I only want to wait for a situation where like I think the money gets completely dried out, like when when further rises for those companies have to happen. Though I've seen their I've seen the term sheets. They really like I think have good covenants in which they can call the money back and all those stuff. But the point is like I think when you coexist in an ecosystem of like I think venture capitalists, and then like you pick and choose your which one you would recall, and then still expect the company to go down. So I think those situations like I think have to come. We have to see that, but they have a good run. I think it's an important part of a pool of capital, like I think which is needed. But experiences, I think let's wait for one more cycle to see. I think whether it can become really bigger. That's what I think my limited point is. But as of now, it looks very good.
Shikhar, Irfan, does that comparison happen when you are talking to clients? Do they compare between your products and VD?
So there's a reason I told you in India, when investors look at credit, they believe credit is supposed to come in all the times. And till date, as Bala mentioned, like venture debt has a unilateral kind of a tailwind. So I think once one headwind comes, because it's a bridge to equity kind of a construct, or in some cases a supply chain financing with a EBITDA negative company. So how long that it will continue? Because currently is assuming that the equity round will come and you're delaying your dilution by taking this piece of debt. I'm not saying it's a bad asset class, but over a period it just matures and let it go through one cycle. I think it will come, but from investor perspective, I think though people understand, these are who have invested in venture debt are reasonably more sophisticated because they have graduated from mutual fund to performing to, but still the philosophy of credit continues to be the same, that it is all okay, everything will come back.
Right. And just I wanted to just add a data point here for those who are interested. We actually did a study where we put together the portfolio of all the venture debt investee companies, try to call out whatever we could from public domain information and so on and so forth, and saw that what's the percentage of companies that are actually or EBITDA positive. I'm being liberal here, not free cash flow positive, EBITDA positive, and I think there were three companies out of portfolio of combined portfolio, a lot of interlinkages, but of 100 or 120 sort of companies, right? So less than 3% are EBITDA positive. We did the same exercise on performing credit. So when we say performing credit, again we try to say whatever is in investment grade, right? So triple B and above. So there, just in the triple B space, we saw that there are 3% of 3.5% percentage of companies are EBITDA negative. So it's actually more than just the flip side around. So it very clearly demarcates, if in my view, right, what a venture debt is and what it isn't. It's an allocation. So performing credit in your fixed income strategy, generally what we tell people is that it forms part of your core allocation strategy after MFs. VD is more of a tactical strategy. It's like how right now GSEC is not something, a 10-year constant duration product is not something you would advocate every day, right? But it's something which is tactical on the GSEC side. Similarly, on the credit side, VD is supposed to be a tactical. When there's tailwind, just like, and you can predict till when the tailwind is, VD is supposed to be there. But again, when macro changes, there could be issues in a VD portfolio. I'm not talking about the funds, but definitely we all read about startups going down. Yeah.
So in lighter terms, if you look at it, when I think is MF is a large cap, we are in mid cap, and that's a micro cap.
I think that defines the positioning of funds. I think most people will remember. No, but very importantly, I think how much any investor should allocate to the performing credit space. I understand the answer is very different or customizable depending on the risk profile, but broadly speaking, as you mentioned, large, mid and small.
I think you should follow the same rule.
So what kind of percentage, or you have seen in your interactions with investors, and there can be different types of investor, what kind of allocation of the fixed income piece should get into performing credit? Anybody can start off.
Maybe I think my thought is that if I have to put my money in the fund as well. So maybe if you have $100,
you're not mandated to put your fund in that.
So $100 of credit, if you have somebody, a sophisticated investor, because he is looking at 3 asset classes, maybe I think credits is something they want to look at, liquid and bond funds, which may be 50-60%, maybe a 20-25% of this asset class, and the rest they can play what they want to do. That's in my mind, I think, if I have to advise somebody.
Yeah, this empirically also we've seen fixed income allocation, those who do tend to allocate to performing credits, 20-25% they end up doing that, the ones who do allocate, or else that 25-30% they end up, the more aggressive ones, they will allocate to venture debt or very high yield sort of funds. But out of your fixed income allocation, still 70-80%, largely people would want to stick to mutual funds, followed by some FMP products that they want, and then 1 or 2 of these performing credit, right? That should form, at least 70-80% of your portfolio. Yeah.
Bala, any views on that?
I think you should give the recommendation. You are the man.
We charge fees for
You
that.
charge fees for that. No, I would not know, but I think ideally the percentage which my co-panelists quoted, I think is a very good number. But I'm sure, I think that will be a large sum available. So I think the people required to manage and all those things, I think the industry has to evolve to that. So I think it might take few years down the line, but eventually it would get there. It could become large, but I think, so that's very clear.
Finally, before we get into the questions and all that stuff, still we have very less number of funds in this space in India. It's not that you have a wide gamut of choices. There are funds who have raised a couple of funds earlier, they've shut shop, gone away. Maybe maybe it's the early stage evolving of the industry, but why is it that there is so less number of fund managers in that space comparatively speaking? Any reason why? Is it a tough business, or is it a space not where people are open to investing? What is the reason why? Any Shekhar, your view, or
so
do you disagree with me? Or
if you put in a global parlance, actually, I think this entire bank moving out and funds like us, or globally as well, credit funds coming, is a phenomenon of last 8-10 years actually. And if you think of just BlackRock's number, which is one of the largest global asset managers, they started with alternatives as an asset class in 2016 with a 10 billion pool actually. And today that itself, if I'm not wrong, is a 300 billion pool actually. So it's a 6 year in for a BlackRock kind of a asset manager actually. In India, I think we used to have a kind of a performing credit or alternates in credit pre-COVID, but maybe post-COVID and even post March 2020, this has accelerated. I feel as we move towards and where the credit growth was also pretty benign, and as we are seeing a double digit credit growth, it will also come in this spectrum of credit, and we will see more capital, more funds will be coming in this vertical as we move for next 3-4 years forward, because this is pretty much aligned with how the credit growth in the country grows. If banks are growing, there is a need for this pool of capital, because Indian promoters have capital starved. So, they will need capital to grow their businesses. We are seeing so many companies where there are buyouts of private equity investors happening, there are family settlements happening. Those pool of capital cannot be serviced by banks, they have to come to us. So, I believe like as we see next maybe 3 years later, if we see in the same panel, we will have a much bigger number. Had we spoken 3 years back, we won't have so many funds in the industry actually.
True.
We are growing actually, and this asset class will grow as we move forward actually.
Understood. There are some questions, if we can take some questions now. I think one very interesting question is that in a high interest rate environment, does the demand for alternative credit from investors come down? Basically, is alternate credit a seasonal industry, or is it it's a perpetual allocation? Anybody?
We are a completely credit starved country, so I think it's not going to go away. So that's it's as simple as that. It's like so much of capital I think is not available, so I think you would always have some borrowers.
Yeah, I mean, so what we see is that people will tend to invest, their asks get higher, right. So, once you are at the from the AAA to the A curve, the transmission is quite fast, right. So, in a rate hike cycle, it's like AAA react immediately followed by AA and A. The BBB space tends to have some lethargy, because one reason being that they do not require capital every day. They are not so entrenched in capital markets that they have refinancing risk on their balance sheet, right. And 3, their liabilities are not as meaning they do not have ECBs and so on and so forth, right. So, they do not have exposure to as many externalities as someone like a AAA and AA does, which is why in a rate hike cycle there will be some lethargy there. So, the initial part of the rate hike cycle is difficult to deploy in a BBB space, because you would be having an investor ask, which is sophisticated investors whose asks would go up. So, the demand for alternative credit goes down, and then you would deploying that and finding good assets will be difficult, right. So, you would tend to move towards a little bit of a higher risk in the initial phase, but what happens is as the rate once it gets transmitted, I am talking about this is just a quarter or a 2 of a lead lag, it is not a year thing, I am just talking about a quarter or 2. So, for example, June mein jo ho raha hai, abhi September mein chal raha hai, right, September, October we are seeing that. Once it gets transmitted, the same thing happens, the BBB space remains lucrative for a very long time, right. So, when rates sort of bottomed out sometime in March, BBB space was still giving such a fat spread over what a AA fund was giving. So, I would still think that it's always it would form a part of a core allocation. It's more of a deployment and a portfolio manager's challenge when they are deploying, but not from a demand perspective.
Because I think the question is that there's no direct, there is a support level for yields. I mean, you don't get the same direct correlation when the rates are on the way down. The spreads when the rates are at the bottom of the market, the spreads between a AA or a BBB or even below that will be the maximum at that point of time. But when the yields actually start going up and they are reaching whatever the yields you are reaching, it doesn't, they go up, but the spread starts coming down, compared to performing credit versus the AAA credit. I think that is the essential question, that whenever the rates were down, maybe a couple of years back or a year and a half back, I think there was a lot of demand for high yield debt, let's call it this way. When the yields pick up so much that you're actually getting 7% from a AAA rated portfolio, unless you get 10, 11 or 10% at least coming in from that. Does that make sense?
I completely differ on that. So, I think the rates are depressed, or I think the yields are depressed because I think there is not much of a business activity. Okay, and that's one of the reasons why I think people are so much money and they are not able to deploy it. At that point in time also, like I think you would have someone asking for money. On the reverse also true, like I think they have got less money, but I think there are a lot of good people are also asking for money, and you will still have that BBB band, like I think who continue to ask money. So, I think in a way, I think I keep coming back again and again. So, I think there is the market is very, very shallow, which is like I think on the one end of the side, which is so called AAA and AA, and then beyond that everyone is the same. Okay, I think we can go back to Irfan's statistics. So there, I think it's like one-to-one negotiation, one-to-one credit. Okay, it's like, I think that's how, like, I think it is. So it's like so inelastic when it comes to that. So I would want to put it, at least like my limited experience of running fund as well as in the banks, like I think, and I used to be part of the banks also. So, it's just that, like, I think you, in your mind, you think that, I think that guy asked so much, so there's a competitive quote. But like money available at the right point in time, faster, like I think, a little more flexible, I think, there is always a price.
Just to add to what Bala is saying, if you look at it, the last 6 months dynamics actually, the rates have gone up by about 90 bips on the repo side. So bond market had quickly absorbed it day zero, like it's done actually. Banks have still not translated the entire yields of, they have done by 70, 80 bips, not, or mortgages have not gone up by that rate actually. And just to add to that same point, as the rate goes up, so people who are borrowing in the bond market, like be it NBFC or a AAA, who may compete with people like us, their cost of borrowing has gone up by 150 bips.
Correct.
So which they have to now originate assets at a higher rate, which means like trades which I would be doing or all of us would be doing at 13%, for example, I think intuitively I price them 200 bips more. That's price has increased. So the delta, I think the best way to compare is what delta you are making actually. The delta has to continue, it should not shrink. Rather, my belief is if the market gets tighter, it will expand rather.
But Munish, the way at least I explained to some of the investors who have this issue, what you're saying is a common question. Point is that when you're investing in a closed-ended product, there is already an implied duration call that you've taken, right? So investors should be cognizant of that. So today, I don't know how many of you know, the 1-year T-bill cutoff was whatever, near 7%, right? So does that mean that between 1 year and 10 years, India, there's only a 40 bip, 45 bip spread for the Indian government, so Indian GSEC should be at, not really, right? It's not a one-to-one, because when you're looking at yield curves, there are, now there's a bear flattener curve at trend at play, right? So in a, when you're looking at rates, there are multiple factors which change the shape of the yield curve. So looking at the short end of the yield curve and expecting that to play out at the 3-year and the 5-year point will not make sense. Just over the last month, we've seen 5-year, 1-year spread go down by 50 bips. So I'm saying that the answer is a little more nuanced, and most investors understand and appreciate this. Is just like Shekhar said, an issue of having that dialogue with them, explaining to them, and trying to break down this space a lot more.
Understood. There's a question on what happens in the case of a default in your underlying company. What does the AIF do at that point of time?
It happens all the time, so I think, so that's the truth. So you have got all the options available to any other lender as is possible. So, we don't fight. That's the philosophy. We don't fight, but we have got enough deterrence. Like I think having a nuclear warhead is not to fight, am I right? It's only to make sure. I think we get to the table, speak, and then try and see, like I think get sense.
When coffee is not available.
When coffee is not available. So I think, you've got options of NCLT, you've got a bankruptcy court, like I think, you have an option of pledge of shares. You've got all the things which is available. But I think, many years back, I think people used to say Citibank steals kidney for your car loan. I don't know how many of you heard it. So I think that was a time, like I think many years back, and then now I think then like that's how it was. But I think because the defaults also used to be very rampant. Okay, credit cards, like I think number of people credit cards people had defaults. There were actually brides and bridegrooms were available. So I think most number of defaults. So I think because you had no way to recover. But eventually, like it all fell in a bracket in which it could be managed, because there were deterrents built in the form of CIBIL and all those things. So I think we are also reaching the same, like I think we have not yet reached, but I'm sure like we will reach in some time, where I think the IBC, like I think the deterrents are more than enough to talk it out and then get sense like what is the loss? The loss is like I think you would have two kinds of non-performing assets, am I right? Like financially non-performing, but they could be operatingly very performing. I'll make a point. We had one fine dining restaurant as a borrower. He had 80 such restaurants. He was doing 22 crores. March 2020, like for saving lives, like we had to shut everything down. So from 22 crores, like I think he came down to 0. Okay. So what do you say, like, is a financial non-performing asset? But as and when like it opens, all of us would need food. So I think, one has to make distinctions and see like whether equity investors can take a hit, because that's why like they are there. So, and how do we like, I think, find ways? And so I think it happens like we have got enough ammunition, NCLT is available, like, IBC is available, like you've got everything is available. But I think, it's not those days of like, I think late 90s, like I think, from ICICI Limited we used to go the lock. Every time there is an opportunity, we can lock the factory. I think that was a wrong way of recovering, but I think then we have learned the lesson. So I think we are back to that stage.
Yeah, I think I agree with Bala, like, and just a lock story, I remember my colleague went to do a surfacey on Enron.
You were in ICICI.
Yeah, ICICI too, yeah, that's what
my
I'm saying.
colleague went to do a surfacey on Enron's plant actually, and he said in a radius of 5 kilometers, all the locks were sold out because they bought every possible
Correct.
lock to put in the grills actually.
No, I think I had stock of locks at my home. So, so when you left, you left. I think that was a mad way of recovering, am I right? That was a completely socialistic country telling that, boss, everyone is bad, you lock, you get them to the street. Then you realize, I think, the jobs have gone. So, now I think it's much better. So I think, I'm sure, like, I think, the environment we will be much better. So what happened in car loan, credit cards, like, would happen here, it will become much better. The equity guys who are the original risky investors would have to lose money, which means, like, I think the performing credit yields could come down over a period. That's given.
But
Okay.
I think the entire
So
environment.
for sure it
legal
will come down. So
legal environment has become very conducive actually, though we may are seeing a wrong side of NCLT, we are seeing cases getting resolved long tenure. But if you see the stats which IBI published quarterly, the number of cases which gets referred, and there is an admission, there is a two-way process. First your reference and then admission. Before admission, 50-60% cases are getting resolved actually, which speaks a lot like the promoters are really nervous. They know that if my case gets admitted, I will lose the company. I myself had never expected. I've handled SR and both Ispat as well as the every possible case on distress in 2002-3, and I never expected that these guys will lose their company because they have various controls here and there. And somebody like a Bhushan and SR losing their company in NCLT speaks of itself. The law is very strong. It has taken time. As we build case studies and everything, we will be much robust. But you should see the stats between reference to admission. There are very less admission as compared to the references. So people are trying to admit, but like it's not getting admitted. They know if I get admit, I lose everything. Let me resolve it before that.
Sharad, thanks. Like I think we had a CFA conference, I think 4 years back, 4 years back, I think when someone asked how good is IBC. So I told them when SR goes down, I'll tell you IBC is good. So I think some of you would remember that. So, I think I'm just saying, like I think we in ICICI Limited would know how tough it was to recover from SR, right? I think I'm not saying anything against them, right? So, but that was a construct which was available to collect money. Okay, it's much better. The balance of power has not shifted to the lenders completely. Okay, and the balance of power which was there on the other side has been neutralized. So there is, like, I think, even if the balance of power has to come to us, it is important that, like, we as lenders, like, use that judiciously. I think we are not here to kill businesses with locks. We need to recover, we need to let it operate.
I mean, on that comforting note that we are not in locksmith business,
Yeah.
I think thank you so much for your
Thank you,
time and
thank
your
you, thank you.
insights. I think amazing.
Thank you.
You'll agree that I think we learned quite a lot from these
thank
three gentlemen on
Thank
the
you,
dial. Thank you so much.
Thank you. Thank you.
Thanks so much, Munish, Bala, Shekhar, and Irfan. That was an absolutely fantastic discussion. Unfortunately, we have run out of time, but we could very much have had you guys speak for the entire day.